Good morning, everyone, and welcome to our first DATIQ weekly market update of 2023. All of us here at DAT wish you a happy new year. This is our update for January 10th, I believe, 2023. I'm Ken Adamo, Chief of Analytics over here at DAT, joined starting a new year with my co-host, Dean Croak, who's our Principal Industry Analyst. Good morning, Dean.
Good morning. Good to be with you. Good to see you back on deck. Had a good break?
Yeah, I sort of unplugged for the first time in probably a long time.
I noticed.
So that was good.
I noticed. No cell phone reception in the woods?
No, chasing, well, we didn't see it. We saw a bunch of pheasants, but not many deer, but it was still fun.
Right.
But,
probably the same deer from last year that we're trying to evade you.
Yeah, again. The same ones. Yeah. Yeah, special shout out to Matt Clark. The dogs won. And I tell you, Matt, if Ryan Day didn't self-immolate in the last 2 minutes, it would have been the Buckeyes beating the Horned Frogs last night. But
yeah.
That just goes to show why you should really only let actual programs into the college football playoff. But, oh, well, it was an early bedtime. So moving back to freight, for those less familiar, I think this is our third or fourth year doing this, but we're here every week, Tuesday at 10 a.m. Eastern, talking about data, trends we're seeing in the freight market, but most importantly, answering your questions. So go ahead and dump those into the comment or chat, and our illustrious marketing team will send those over to us towards the end of the show. But to keep us moving, I'm going to move on to key points of the week, which are... So the rumors of the demise of Peak were greatly exaggerated. You'll see later in the show, we have some data on how Peak actually materialized pretty much from October on. But spot rates are beginning lower than 21, but within a few pennies of 18. I think there's some really interesting year-over-year comps here we're going to be taking a look at for the next quarter at least. Active contract rates are flat to slightly up. What's really interesting is if you look at some of the monthly data, December spot rates showed either flat or up, depending on kind of what you're including in that aggregate for the first time since January of last year. So some positive signs that the market may be bottoming coming in out of late December. National produce volumes down 8%, 8.5% actually year over year. California down 21%. December Class A truck orders up 33%, and the calendar year, there's some interesting information on cancellations there, though, which I'm sure Dean might mention. And then imports down 1% month over month and 12% year over year. East Coast port congestion slows west to east as LAX, or LA Long Beach, regains number one spot for imports. I'm going to turn it over to Dean to walk us through the market update in more detail. Dean?
Yeah, thanks, Ken. Lots of interest in California this week. They even had earthquakes yesterday, in addition to all of the flooding rains they're going to have over the next 10 days. So the hope is that it fills some of the reservoirs there without too much of it running off into the ocean. So let's dive into our market update this week and start off with dry van load to truck ratio. Last week, of course, was another short week for shippers and brokers. Load posts came in at just over 1 million loads, almost identical to where the dry van market started in 2018. Last week was the first time load posts exceeded 1 million since the volume surge just after Thanksgiving. Equipment posts remained at the highest level in 6 years. That's been the ongoing story for the last quarter. Lots of excess capacity in the market. The load to truck ratio remained unchanged at 5.56. In the refrigerated market, similar story. Load posts were up last week. Second highest volume, though, in the last 7 years for the first week of the year, and only just 13% lower than in 2018 at the start of that rate rally that lasted about 6 or 7 months. Carrier equipment posts, though, at their highest level in 7 years, more than double the number of carriers posting their equipment during the prior oversupplied market in 2019. Load to truck ratio down slightly last week to about 10.18 from 12.87. And in flatbed, load posts started off 2023 at about a quarter of volumes this time last year, really reflecting just how much demand has cooled off in many of those markets. Steel production ended the year down 10%. Single family housing volume down 30% compared to this time last year. We're building about 400,000 fewer homes in November compared to November 2021. So in the flatbed market, equipment posts were at their highest level in many, many years. Load to truck ratio up slightly to 15.5. And in the market condition index sector of our report, having a little bit of a look at California this week, where they've got a lot of rain. As you know, dry band spot rates in California were down at a state level, but at the same time in Northern California, hardest hit by the ongoing series of atmospheric river events. Load posts were up in Stockton, one of the biggest warehouse markets outside of Ontario. Volumes are up 26% week over week. Some of the lanes, including Stockton to Portland, spot rates up to 20 cents a mile to an average of $2.72. Even though that's an increase, it's still $1.65 per mile lower than this time last year. Similar trend on the longer haul lane from to Seattle from Stockton. Rates averaged $2.47 last week, still $1.85 lower year over year. While not a large outbound spot market for carriers, capacity did tighten in Medford, Oregon, just north of where the rains are or have been last week. Spot rates for outbound loads were up 13 cents a mile to $1.76. Load posts were up 62% last week, also in that market. In Houston, load posts are up 33% week over week. Capacity did slighten tightly. Outbound spot rates are up a penny a mile to $1.86. Long haul loads from Houston to Spokane, Washington, to about 2,200 miles. Rates are up to $2.29 last week, following 9 weeks of gains. And at this level, they're still around 35 cents per mile lower than this time last year. Having a look at the refrigerated market, looking at the San Joaquin Valley in the Fresno freight market, the biggest produce market in the country, capacity was relatively flat last week. Rates are averaging $2.05 for outbound loads, but considerably tighter on some of the longer haul lanes to the east. Fresno to Boston increased by 23 cents a mile last week to $1.90. Remember, folks, this is excluding fuel, so these are line haul spot rates excluding fuel. Line haul rates on the Fresno to Boston lane have been steadily climbing for the previous 3 months, but they're still about $1 a mile lower than this time last year. In Phoenix, reefer capacity tightened for the 5th week. Spot rates increased by 18 cents a mile for outbound loads. The average was $2.54. And in the Winter Salad Bowl in Yuma, Arizona, or partly in the Phoenix market, capacity did tighten. Loads from Yuma to Atlanta up 27 cents a mile, above the December average, up to $2.19 a mile last week. Loads to Seattle were running at about $2.86. Capacity was tight in mid-Atlantic markets last week for refrigerated carriers. Rates were up 5 cents a mile to $2.04, with most of the gains coming from the Charlotte market, where spot rates increased to 14 cents a mile, to $2.15. And wrapping up our market condition index with flatbed, having a look at some of the Pacific Northwest lumber markets. In Oregon, spot rates for flatbed carriers increased 23 cents a mile last week. The state average bumped up to $2.61. That's right around where flatbed rates in Oregon were in 2018. In the Portland market, which is one of the bigger flatbed markets in the region, load posts were up 37% last week. Still plenty of available capacity for loads back out of that backhaul market. Average rates dropped 41 cents a mile to $2.47. In the neighbouring Medford market, outbound flat rates dropped by 8 cents a mile to $2.58. Loads from Medford to Denver, 1,300 miles, were up 10 cents a mile to $2.14. While loads south to Los Angeles were also up by 12 cents a mile to $2.53. While capacity for loads to Phoenix also loosened. Outbound Texas rates start 2023 at the second highest rate in 7 years at an average of $2.22, which is still 42 cents a mile lower than this time last year. But Texas remains one of the strong markets for flatbed carriers comparatively. Loads out of Houston at $2.38 a mile as a national average were down 30 cents a mile last week to $2.38, even though there was an increase in load posts. There's still plenty of capacity in that market, even though rates are historically higher over time. And wrapping up our year-over-year look at spot rates, the national average dry van rate started 2023 27%, or about 73 cents a mile lower than this time last year. At $1.97 last week, excluding fuel, rates are around 30 cents a mile higher than in 2020, right before the pandemic started, and about 27 cents a mile higher than the average of the 5 pre-pandemic years for the first shipping week of the calendar year. The national average rate of $1.97 is still about 30 cents a mile lower than the top 50 dry van lanes for DAT based on volumes of loads moved. And in the refrigerated market, last week's national average line haul rate at $2.37 is around 25% or 80 cents a mile lower than this time last year. Reefer spot rates typically start the year strong before cooling over the first quarter, except for 2018, when capacity was relatively tight for most of that first half. Last week's spot rate was just 3 cents a mile lower than this time in 2018. And wrapping up with flatbed, line haul rates began the year at $2.15. That's about 54 cents a mile lower than this time last year, but within 2 cents a mile of 2018 levels. That's a very interesting comparison, as Ken mentioned, given 2018 was a rate rally primarily driven by flatbed and a very robust industrial economy. The national average flatbed rate is 23 cents a mile higher than in pre-pandemic years for week one of the shipping year. So that's it for this week's market update. If you'd like to find out more about what's happening in freight, go to dat.com/market update and download our weekly report, which will be published this evening. And with that, it's over to Ken to take us through the short-term forecast.
Thank you, Dean. This is always a very interesting time of the year for the short-term forecast as we're coming off of the peak season. Just to level set everyone who may not be familiar, this is our short-term forecast powered by our forecasting ensemble. We start with dry van. It's long haul only, very long haul only. I think we pull 550 miles and above for this. It goes back to August in this particular view. The blue line is the historical observed weighted average, so it's a 7-day weighted moving average. The red line is the short-term forecast. It more heavily weights near-term data. The green line is RateCast. That's our flagship forecasting model. It's in all of our forecasting products, RFP tool, etc. And then the gray and the yellow are blends of the two in varying degrees. So what you're seeing here is we had a pretty stellar run-up in rates to end the year, a few weeks later than typical peaks, but still ended up right about where you would expect to see by the end of the year. The decrease in fuel certainly helped because these are excluding fuel. But you're seeing RateCast really wanting to assert that seasonal drop-off that we would see in rates around this time of the year. Once returns are over, freight market really, really slows down. Even in absolute boom years, freight tends to slow down. If you remember, even in 21, things really slowed down before the polar vortex and then Delta variant hit. Short-term forecast is a little bit more optimistic. It's sensing some of that strength in the market that exists right now in lower fuel prices and buoying up rates. Still coming down, but maintaining at a little bit of a higher level heading into the middle of February. Reefer, pretty much the same story, just a bit more exaggerated. It's really what you expect to see. There's not as much lingering demand for reefer freight as we head into this lull period as you would see for dry van, and the forecasts very much reflect that. Interesting. I'm going to move to flatbed. It's less impacted by some of the seasonality right now. It's sort of been in that seasonal trough. It's of course going to have a run up, mainly driven by driver out of service. But it wasn't nearly as pronounced as the other two equipment types, which means the fall off likely won't be as pronounced. I really do agree with Dean here and think that produce, it'd be fun watching produce on the back of a flatbed, but new housing starts and building materials are really going to be what's going to tell the tale, I think, for flatbed as we head into 23 and work our way through the year. That's our short-term forecasting view. So we're going to move next to our question of the week.
Yeah, Ian? Ken, question of the week. Now that it's over, how does peak 2022 stack up to prior years? Very interesting question.
We have a visual aid. If you remember at the start of peak, we showed this visual, which I think we'll pull up next. And I love this, right? So this is the dotted lines are previous years. It starts right around day two, actually right at day 270. And then it's just indexed. It's I think a 7-day weighted moving average indexed to the start of the year. So it's not perfect. Neither Dean nor I are statisticians, but it's pretty okay. And it just shows you how each of those years moved throughout the entire course of peak. So from where they started, the 7 days heading into peak, and then using that 7-day weighted moving average to show the shape. And then the red bold line is essentially the aggregate of all historical non-COVID years represented here. So what you see is 2022 is the green line. And it started out right where you would expect, pretty much exactly like that historical trend. But then, we were really sitting around questioning whether we were going to see a peak season, heading all the way into roughly day 320 of the year, about 50 days after the start of peak. And then things sort of shot out of a cannon and really caught back up. And you can really see that we ended the year actually better than what the historical average would be, and very close to a year like 2016, which finished strong heading into 17. So that's really how the tail of the tape, if you will, for peak dry van spot rates, excluding fuel. What do you think about this, Dean?
Yeah, I think it mirrors what we saw in the market, which was a pretty lackluster Q3. We saw, and I think part of the reason the green line has been dragged up so steeply in the back end of Q4 was the surge in spot rate volumes we saw immediately after Thanksgiving. So we'd seen fairly mediocre volumes. They were over 1 million for an interesting part of the year, probably more the middle of the year. But in Q3, they dropped down substantially. But in the first few weeks after Thanksgiving, they were averaging around 1 million loads a week in the dry van market. So I think that surge in volume immediately after Thanksgiving dragged the market up, provided some much needed volume for carriers, dry van carriers, that is, through the holidays. And then, of course, the end of the year is impacted also by the amount of carriers that take time off in the market. After some pretty good years, I just, again, anecdotally, I see more carriers taking time off than they would have done in prior years because they've had such a good financial period. And I say that noting that operating costs have gone up, but carriers are still coming off a pretty good 2021.
Yeah, I mean, I think we can move off this chart. Honestly, we could probably spend another hour talking here live, and just because I've really been, now's the time when you reflect. I feel like we're also busy to end the year in the freight market that you don't spend a lot of time in December like most people do reflecting on their year. You do a lot of it in early January. And what I found was interesting was if you'd ask someone blindly, just based on how they felt, right? Was 21 a better year, or was 20 a better year, or 22 a better year? What would you say, Dean? I
would say 20 from a carrier's perspective, 2021 by far.
I'm sorry. I goofed. 20 or 22 are your two options.
Gosh, that's a tale of two halves in both cases. Right. Back into 2020 was a cracking second half. Probably 2020, Ken. Because diesel prices were so low. That would be the main reason.
So that was unscripted because I think Dean nailed it, right? I think even he can't tune out from what he knows intrinsically. But I think if you polled kind of more casual operational folks, not analysts, they would instantly say 2020 was the better year. 2020 was a great year. It was the COVID fueled boom. But what I think people forget to realize is how painful the start of 2020 was. Mm-hmm. And when you look at 2020 and you compare it to 2022, they're almost the exact year in reverse, like almost to the penny. Mm-hmm. Where if you look at where 2020 started and ended versus where 2022 started and ended, it's almost a symmetrical, like mirror image of itself. And that's with some smoothing, right? Because we had that massive hiccup when the whole world shut down in the beginning. But I think that is just sort of emblematic of over the long arc of time, how predictable the freight cycle can be, right? I mean, if you look at all of these cycles, they do come down a little faster than they go up. That's kind of one steady thing. But that shape is pretty darn, you can pretty much set your watch to it, I would say. And I think from a perception standpoint, 2022 was like the bloodbath that wasn't. It was essentially this return to normal. Now, I think as we sit here and analyze the market, I don't want to speak for both of us, and I'll let you chime in here, but I have considerable more worry about 23 than I did at any point in 22. Would you echo that sentiment?
Yeah, absolutely, because we've still got a lot of capacity in the market. Even if volumes end, as Jason Miller said on our show, are relatively flat to maybe slightly down in December, and by all of the reports, it looks like that's where demand will end up. We've still got a lot more capacity in the market, as evidenced by some of our carrier posts at 6-year, 7-year highs. So I think we've still got a carryover effect of the second half of 2020, where up until that point, for about 4 or 5 years, we were adding about 1,000 carriers a month, net new carriers, when you take into account new entrants with DAT authorizations and exits. When we got to July of 2020, when the PPP loans ended, the number of net new carriers surged And over the period of the pandemic, it averaged about 4,000 net new carriers a month, but started to turn negative in October last year. So to your point, when you look at the data and overlay it with spot rates, you can see how supply came in to take advantage of the very high spot rates. And then the net change started to decrease significantly when spot rates dropped in the first half of this year. But it does look like that's starting to bottom out. We may have seen the bottom. That's probably could be too big of a hot take to start the year, but it looks like the exodus of carriers may have peaked in October, November. Just looking at the net change in authorizations, new and exits from the FMCSA data. Let's hope that's the case.
Yeah. 2019 was the bad year. And if you look at it, it didn't have much rate movement in it. It was just the amount of time we persisted at a near bottom, right? The back from 4th of July on is when the bottom fell out. Like that's when the market corrected in 18, right? And everyone talks about 18 with, rose-colored glasses and they think nostalgically about it. But the tail half of that year is when rates moved. 19 is when they didn't, which was the problem. Now, I think you make a great point about we've seen some relief on the carrier side that doesn't manifest in base rates on the fuel side, right? If diesel can continue to inch down closer and closer to $4 a gallon, that, in my perspective, would take a lot of the pain off of, especially the small carrier market.
Right. Yeah, it's still even though the EIA forecast summer at about $4.30 a gallon. That's still probably not low enough for most of the carriers in the market. Need those rates or price per gallon really needs to come down much lower than that. But there's still a lot of pain out there. I think there's more and more carriers, though, are getting far better than the national average. That's as I mentioned to you before Christmas, Ken, a good friend of mine runs a reefer in the spot market, runs 48 states, carrying brokered freight. Gross 400,000 last year, so he averaged about $3.30 a mile over the course of the year, which of course is way higher than the national average. And that's, I think there's a lot of carriers out there that are doing particularly well with good load selection. Johnny, my friend Johnny, I said, what's the key? And he says, I like to run a lot more regional loads. So he runs a lot of regional loads around your area, Ken, this week, but he's making much more revenue per day. So I think there's a lot of smart carriers out there that have figured out how to make good margins in this market.
Yeah, I agree. And I think too, on the flip side of that, like the exact opposite side, there's a lot of shippers that are rethinking their fuel strategy as they hit into the year, right? Should they put regional fuel surcharges in place? If you don't have a California or New England footprint, you're getting whacked with that effect. I mean, I think it's still over $1 a mile, $1 per gallon more than the national average in certain pads. So I know for a fact that a lot of shippers are thinking about that just from discussions we've been having. So there's going to be a lot of interesting things. People are getting back from break. They're really looking at their priority list for the year, and they're going to be very ambitious, I think, to cross some of those lingering issues off as we get a head start into 23, right? Because we're going to be busy again. I mean, there's only about a month and a half here before things start to pick up for produce and spring shipping season. So a lot of these, whether you're a traffic manager or a procurement specialist or you're a broker ops person or a carrier, the true lull really only lasts for a month and a half or so before things start picking back up in the spring. So now's the time to lick your wounds and retool and get ready to go for the year. Do your taxes. All right, questions?
All right. Yes, some questions. This is a good question. I think you might be able to handle this one, Ken, because I don't know the answer, from Gary Bates. Have brokers laid off their agents because of lower volumes? And are they trying to survive by taking more money from carriers who may not survive? So in turn, the broker may not survive? Interesting question.
I mean, I think, again, we study a lot of this stuff on the margin, right? When we talk about, I think there was for one of the publications, there was a top 10 carriers that went bankrupt during the freight recession, and then they only name 8. I think you have to consider how much headcount was added during COVID to support the added volume. So I'm totally making up numbers, but if you take just a standard mid-sized brokerage, nothing big, right? $20 to $50 million a year in revenue. which is probably way towards the bottom of that top 100 or top 150 broker list. They probably, since pre-COVID, since 19, I would say on average, they've probably added anywhere from 25 to some of them as much as 50% more headcount to fuel their growth. Not just in sales, not just in carrier sales, but in HR, billing, back office, et cetera, et cetera. And so when you see some of these big brokers reducing staff, we're seeing reductions in the, 1 to 10% range. I haven't seen a major outfit curtail staffing by more than 10%. I don't know if you have, Dean. No. So when you look at it, sort of aggregate, net additions minus attritions, they're probably still up 15 to 30%, depending on how much growth they experienced during the pandemic. And I think another thing to consider, a lot of these reductions that are widely publicized, they're a aggregate of early retirements, true separations, reduction of open headcount, counts as a layoff, if you will, right? So if I'm hiring for someone and that position gets sliced, that's one of the X number that are getting. And I think what you're also seeing is the recruiting and HR divisions getting hit hard at these bigger brokerages because they're not going to, they expect a return to normal. They may only hire 200 people next year instead of 400. Right. And so if you're hiring half as many people, it stands to reason you need half as many recruiters and onboarding specialists and probably back office people to complete I-9s and all the stuff to get the people through the door. So I think you're seeing more and more of that. What I would look out for, so that was the optimistic view. What I would look out for is when you start to see large numbers of carrier sales reps, enterprise sales reps, SDRs, BDRs getting let go, that's more of the canary in the coal mine that they expect a rather dramatic slowdown in their businesses, like a systemic slowdown in their businesses. That's a long-winded answer to say. I think you're seeing more right-sizing in staffing at the moment.
Yeah.
I certainly don't think they're taking money out of loads to fuel being bloated from a headcount perspective. I think they're paying market rates and carriers are accepting market rates. If carriers could garner more, they would. If brokers could pay less, they would. Right? No broker is generously paying more when they don't have to. No carrier is generally out of the goodness of their heart accepting less than market just because they want to. So everyone's paying what the market rate is for that particular shipment.
Right. We've got a question here, Ken, that I don't know that we've got a lot of data on. I certainly don't. From Daniela Ortega asks, will you talk about drayage and rates? My knowledge on drayage rates are fairly limited. But I'm not up to speed on what's happening in the drayage market just now. So we may have to take that on notice unless you've got anything to add, Ken.
Let's try to get a drayage expert on. I mean, I know the couple that I know, their blood pressure's down without medication. I mean, we talked to, we sort of have like these triangular connections, right? So we might not be talking directly to the drayage company, but we might talk to a data agency that has contacts at both. I mean, they were draying freight from Baltimore to Buffalo.
Yep.
And this is nuts. Or Baltimore to Pontiac, Michigan. It's like, what? So I do think, one thing I do know, so we're going to follow up and we'll try to get someone that knows drayage. The shift back west, if LAX can regain some more, or LA Long Beach can regain some footing, will take some taxing off of that southeastern drayage market. They're not used to those volumes that Southern California is used to. So it's just something to think about.
There's a follow-up question that pertains to that, Ken, from Two Tired Parents, aren't we all? Do you have any analysis pertaining to ports and containers? We've just done our analysis of the December imports. It's in my blog update that'll be published this evening. So if you check it out, all of the latest data will be in there around ports. But it does appear, though, that just based on December data, we're back down around where you would see 2018, 2019 imports at around 2 million containers a month on the inbound side. It appears as though the congestion on the East Coast has slowed down the volume of containers coming into the East Coast. That's why we started the show with a comment about Los Angeles picking up the number one spot again, where it's traditionally been. One more question, Ken, if we've got time. John Pandol asks, is there more business shipper to asset-based carriers? I think the answer is yes. We've seen that over the last year, and the percentage of brokers involved is less. Great question, John.
Yeah, it is. It has been moving back, right? So if it's typically 85-15, being 85% direct to asset and 15% spot, of which most goes to brokers. I forget, Dean, where it topped out exactly during the height of the COVID crazy. It was like 70-30 maybe?
It was probably maybe closer to an average of 75-25, but on week 70-30. Yep.
That's a lot, right? So I know that sounds like a small increase, but increasing the share up, 10 nominal percentage points is a lot of freight when you consider how disproportionate spot and contract is. It has been moving back. The most interesting thing I think I saw from our analytics team internally, as we have these things like, we just discuss on Slack and whatnot, it's more of a fallacy that shippers proactively shuttle freight to the spot market when rates, to take advantage of lower rates, especially after what we just experienced. They're trying to just get the service and keep the routing guide intact. And again, not huge numbers, but we saw, I hope I'm not misquoting here, nearly 200 basis points, so 2 nominal percentage point increase in sort of like voluntary spot market shifts from shippers. And when polled about it in some of our roundtables, they said, look, the rates in the spot market were just too good not to take advantage of. So where it made sense for us, where it strategically fit, we shifted some volume over to the spot market, which, again, a massive base shifting a small percentage can still mean a large chunk of loads coming into the spot market, which my guess, Dean, is what we saw, at least partially attributable to that healthy fourth quarter volume that we observed.
I just did some quick numbers in the background on our dry van load posts for the year that ended at about 61 million. That's down about 15 million on last year, which is notable, but not far off double where you'd normally see volumes over the prior pandemic years, going back to 2015. So we are definitely seeing more volume in the spot market over time. Even though the share between spot and contract has decreased, there is definitely more volume moving shipper to broker in the market. And we've seen, particularly it was evidenced by the 2 4-day weeks or the 4-day weeks between Christmas and New Year, going back 3 years. I think we saw about 10% more volumes this year than we would have normally expected. So definitely more volume. And the last question is, I could tell you a lot about livestock haulage in Australia, having done it for years, but I don't have any insights into livestock haulage here in the US, Scott. But we could probably share some stories if you wanted to write to us at askiq@dat.com. We might be able to answer that question. That's all we've got, Ken, as far as questions go.
So we'll wrap up for this week. We're looking forward to an eventful 2023. Lots of great guests, topics, hopefully a lot of fun things to talk about. Any plugs, Dean? Am I missing anything?
Yeah. You're going to be on Sales Chatter tomorrow with Dan Deegan, Ryan Mohammed, and Jeff Dickinson at 9 a.m. Eastern. You can connect with them on LinkedIn. Robert Rouse from DAT is on Landline Now on Road Dog Radio 146, 7 p.m. tomorrow evening on Landline Now. And I'll be on with Jimmy Mack on Thursday, at 8 a.m. Eastern on Radio Nemo, again, Sirius Channel 146. And with that, remember you can download our weekly market update at dat.com/market update or on our new IQ dashboard at iq.dat.com.
Yeah, and I have to imagine our freight line is going to be dropping at some point, our end of the year ramblings.
Yep, hot takes.
Unless it already did. Did it already come out? Am I just like that far behind?
I missed that today. That's the one thing I didn't do this morning. How remiss.
Our brains, they need to recongeal and get back, just like our bodies, they atrophy. All right, well, I want to thank everyone for joining us. Again, I'm looking forward to spending the new year with all of our viewers, and I hope you have a great week, and we look forward to seeing you next Tuesday at 10. Bye, everyone.
Bye-bye.